All right, what's going on, folks? Happy Wednesday, April 9th, 2025. My name is Hamilton. I'm here at the Trading Initiative. What a wild series of days. We've been streaming live every day for the last, I believe, 5 or 6 sessions here, and the theme remains the same. Risk off, risk off, risk off. There's a lot of people. Amigos, that is the wrong way to attack this type of market in free fall. Do not put your ego and your bias in front of what your technicals tell you to do. If you follow what the technicals and the rules that you have in place, you will survive to fight another day. That's where I want to start before heading in towards this kind of credit event risk that we've been talking about over the last 12 hours here inside of TTI. The 200-day moving average tends to be the great equalizer when it comes to trend management, understanding where price is in terms of trend below the 200-day moving average, obviously being more bearish than bullish, and above the 200-day moving average being more bullish than bearish. A very, very simple rule that if you missed this move to the downside, meaning you remained long and or you continued to buy the dip, I implore you, add this rule towards your trading system. Below the 200-day moving average is a bad environment to add to longs on a tactical or a swing trading time frame. Okay, S&P 500 down 1.7%, a super volatile overnight session as well. We were down as much as 2.5%, I believe, and now we're down about 1.7%. But these are intraday moves that I have not seen since the GFC. I started trading in 2010, so I was not even trading when these moves were happening. I was studying them in 2010, but these types of intraday volatile moves, very few people have had experience trading these types of things. What I will say is, from a day trading or a scalping perspective, this is your World Cup, this is your Olympics, this is your Super Bowl all tied into one. If you are an intraday trader, day trading or scalping, and you're looking at this type of environment and you're saying, this is too difficult for me, you need to figure out a system that will allow you to take advantage of this type of intraday volatility, because this is where you make your millions. On a swing trading and position trading standpoint, though, this environment continues to be very dangerous for allocating new capital. It's dangerous to add shorts here because we're already down massively. We don't want to short the whole. We also don't want to long here because there's too much volatility and risk that the market continues to break down. We do have some levels that we're looking at. They have held up well. 2021 highs are what I'm looking to gauge in terms of a steeper correction or not. The S&P 500 as of right now finding support at the 478.50 area. As you can see, we topped out there at the end of 2021. If we fall back in there and fall back within this range, I think there's a way bigger issue at play, and I think that's a very real possibility here. We could potentially break down below it. I don't have any downwards exposure to express that thesis. Instead, I'm sitting in a majority cash here. But a drop below 478.5, I think there's a bigger and more aggressive move to the downside coming. If we hold that 47.850 level, I think there's an opportunity to start looking at longs, but that is not in play yet. The Qs following a similar pattern here, holding their 2021 highs at 405. Once again, we flip below 405. Bigger correction potentially incoming. We hold this 405 area. I think that's a great area to start thinking about where you want to start placing some risk back into the markets. If we flip back under these key levels, those 2021 highs, it's a relatively short cut, which is great. You lose just a couple of bucks on these trades since the stop is so tight, but if it does hold, then obviously the risk to reward is juiced up here. So it looks good. Okay. So what I want to get into really quick is the credit event risk that we were talking about yesterday. We've talked about this extensively inside of TTI. It's one of our risk ratios that we look at on a consistent basis here. But something that really started to blow out here is your HYG against IEI. And I just want to show you really quick what each of these individual assets are, explain them, and then look at the ratio in and of itself. So HYG tracks high yield corporate debt, right? Riskier debt instruments, generally issued by companies with lower credit ratings. Traders, investors, they tend to buy HYG when they're comfortable taking on more risk because there's obviously the potential reward for higher returns. So what we typically see is in a stronger bull market or a strong market, HYG is getting bought back up. And it has been, right? HYG started to take off at the end of 2023. It's been a relatively strong uptrend following its 200-day moving average before breaking down along with the broader market a couple of sessions ago. On the flip side, you can look at IEI, which is Your safer intermediate duration treasury bonds, right, issued by the U.S. government, investors and traders tend to flock to IEI or other U.S. debt in terms of when market risk or uncertainty spikes. So if you think about HYG being the riskier corporate debt, which offers higher returns, and IEI, the riskless, air quote, debt that investors and traders flock to in market uncertainty spikes, it's reasonable to assume that in a strong market, HYG is taking off, and in a weak market, IEI, at the very minimum, should be outperforming. And that's exactly what we're seeing over the last couple of sessions. Flip this over to a line chart, take off the RSI, and let's take off the 200-day moving average because it doesn't serve any purpose here. What we're looking at from a ratio standpoint is a risk sentiment, and these are not retail traders moving this market. And I think that's the most important part about all of this. You go on Twitter, you go on YouTube, you listen to people yap about their ideas and their opinions and biases, and all I'm going to say is retail traders do not hold significant sway in the market whatsoever, so it really doesn't matter what any of them say in terms of broader market structure. If your favorite YouTuber is going out and selling a stock, 9 times out of 10, if not more, that stock is not going to move based off of their sell orders. So what we're looking at here are the most liquid and sophisticated investors and traders in the world fighting each other right now over risk sentiment. As you can see here, this ratio has performed relatively well coming out of the bear market of 2022, relatively strong uptrend here, but we started to break down over the last couple of weeks, not sessions, but weeks, in the ratio at least. So you could tell that this was coming a couple of weeks before we actually got the breakdown in high yield corporate debt. And now we're in full-blown potential panic mode. Something to consider here, I'm going to put it back to a candlestick, is the August 5th breakdown. Part of the problem with everybody on YouTube and Twitter and the TV in general is the fact that they've been screaming for the last 3 years that the market is going to implode and everything's going to go to zero. And then by the time something actually happens, nobody believes them anymore. Or even worse, they don't have any money to make profits off of the breakdown because they've been shorting uptrends for the last 2.5 years. It's a very difficult way to make a living in the market long term, shorting uptrends. I don't suggest doing it. But having said that, the August 5th breakdown was supposed to be what's happening right now. The Japanese yen carry trade blow up was supposed to end the global financial markets. Everybody was running around freaking out, and some of that might have been merited. But one ratio that kept us in the game was this particular ratio, HYG against IEI. We sat there and we looked over the next couple of days after August 5th and asked ourselves, if this really is as big and systemic of a threat as everybody is making it out to be, why is credit not breaking down? You can see relatively quickly credit recovered and then continued its uptrend. So for us, just a couple of days after the August 5th breakdown, we started buying stocks again at great discounts, and those ended up being the best trades we put on all year last year. Made a bunch of money on some of the Mag 7 stocks. Tesla did well. Meta did fantastic. Amazon did well. Just threw off the top of my head, we were long App, we were long Palantir, right? Those were the big winners at the end of last year. But this situation is completely different. When high yield corporate debt breaks down against IEI, it's a measure of credit. And what we're seeing here are the most sophisticated and largest investors and traders in the bond market tell us that they are shifting drastically to risk-off measures. Now, I don't care what anybody on Twitter or YouTube says. Someone's going to come out and say, I'm an idiot. You don't understand credit. Someone's going to be, a bond trader. They're going to say, you don't. What I do understand is that when this ratio is going down, and you can back test this, the market is not generally performing at its best. Particularly when you see these essentially capitulation zones where this ratio flips to the downside like that, just within the blink of an eye, like we saw during the COVID crash. Now, that's not to say that this is going to linger. This is going to be an issue for the next 10, 15, 20 years. I have no idea. I'm not that type of trader. I'm a technical trader. I set levels and follow trends. But what I do know is that when I look out at an equity market that is in a technical bear market now, right? The Qs are down over 20%. I believe as of this morning, the S&P 500 is going to be down 20% or damn near 20%. And we see credit blowing out. This is a bigger deal at this point. A bigger deal. So what we're looking for in terms of a potential bottom in TTI at least is we need to see some of these risk ratios start to flip back to the upside. It's part of the reason why we haven't bought the dip. If you're a part of TTI, the trade ideas that have come out have drastically been reduced since the beginning of March. I think we've taken less than 6 or 7 trades in the last 6 weeks. Some people would sit there and say that's boring. Other people would sit there and say, thank God I'm not losing money trying to time this market bottom like all the other suckers out there. However you want to look at this is completely up to you. What I will say, though, is when risk ratios start to bottom out here, when high yield corporate debt starts to find a floor, when it stops capitulating, that would be a pretty good sign. Is there a potential bottom forming in the market? We need to see credit stop blowing out here. And by the way, this has a long way to go. This by no means is this like the most extreme reading we've ever had. Obviously, you can see down here during COVID times. But this is concerning. This is absolutely concerning. It's bigger than just an equity issue now, right? This market falling out is bigger than an equity issue. It is now a bond market issue. And that is a serious problem here. As a matter of fact, just a couple of sessions ago, and I put on a long bond trade a couple of sessions ago. I'm not afraid to say it, but I'm going to be stopped out of this thing because it immediately reversed after breaking over the 200-day moving average. This was an inversely correlated asset to stocks over the last couple of months, not just weeks, but months, right? Stocks have been coming down since. They peaked in December, right? Middle of December, December 16th. I think the indexes peaked in February, but you can see bonds started to catch a bit at the bottom of January. And up until a couple of sessions ago, they were bucking the trend. They were inversely correlated to stocks. Stocks were coming down, bonds were going up. I took a stab at a 200-day moving average breakout on the TLT, targeting $100. I'm going to be stopped out, but this is an aggressive move to the downside in bonds now. There's no place to hide in the market from an inverse correlated asset, except potentially gold and to a lesser extent Bitcoin. Bitcoin's holding up relatively well, but it's hard to imagine that doesn't also fold down to the 70K level eventually. But bonds are blowing out now. And I think that's the bigger issue as well. When the bond market gets involved, all of a sudden it's not just an equity market issue, it's a bond market issue. And you know, if the bonds are getting hit, the Fed is going to have to react. The Fed doesn't necessarily care too much about equities. They care more about the bond market, and bonds are starting to give us a picture here that is not so great. As a matter of fact, we're not that far off from multi-decade lows in bonds. If we go back and look at something like a weekly chart, you can see the last time we were down at these levels that we're trading at, if we blow out the 82.5 area, is going to be post-dot-com bubble. I mean, this is not good. This is a bear market in U.S. Treasuries, and it continues to look like we're going to potentially break to the downside here. What are the broader ramifications for that? From a technical standpoint, we could take these trades. I think it's important to understand that from a technical standpoint, we are not married to one thesis whatsoever. We put a trade on. If it invalidates and breaks down below our stop loss level, we get out of the trade. We move on to the next trade without losing enthusiasm. If we find ourselves losing 5 or 6 trades in a row, maybe it's time to reassess market conditions. And that's kind of what happened at the end of February, beginning of March. We put on a bunch of trades. Nearly every single one almost immediately failed. That's when we started to realize maybe there was a changing dynamic in the market. So we stopped putting full positions on. We started taking feeler positions a couple of weeks later. Some of them worked, some of them didn't. We realized that market conditions were not improving. That was off of the 200 area retest back here. Just happened a couple of sessions ago at this point, it feels like, or maybe a week and a half ago. Up in here, we were throwing some feelers on this little area here. They didn't work as an entire group, so we stayed out. We have not opened up a position with full size in weeks because of that. So we've been able to sidestep all of this drama. Something important to talk about really quick for most of you guys. Most of you are not going to be able to sit at your computers all day, every day, right? Most of you guys are going to be working. You have a company to run. You have a family. You have outside commitments. You do not need to be vested in this market to the downside if you don't want to. Sitting in cash is totally fine. Shorting this market is going to be harder than longing this market. Twitter is a facade. Everybody makes $1 trillion in market sell-offs, but they don't make $1 trillion when the market rallies because they're bear biased. And most of the time when you are short the market, any sort of intraday rally will zero out those puts, particularly in a situation with the VIX as high as it is. So if you don't want to be part of the drama, if you don't have the time, which is really the big issue here, if you do not have the time to sit in front of your computer and trade all day, you don't need to put shorts on the market. Just sidestep it. Sit in cash. Wait for better trends to emerge. With the VIX up here at 56, I believe this is the highest close we've had, since COVID. And it looks like we're going to continue to spike in the VIX. This is not an area where you're going to be wanting to open up a lot of options trades unless you're hedging against volatility crush. It's another thing. If you're looking to buy straight puts or straight calls here, you're going to be paying more for the opportunity to take a directionally biased play. So if you buy a put and the market doesn't immediately capitulate, or even worse, it rallies like it did 2 sessions ago and blows everybody out of the water, you're going to be down relatively quickly, and you're going to be down a lot depending on how much you parked into it. So that credit event risk is a very, very real problem. It's something that you need to be able to understand to have a bigger picture in the market, which is what we do inside of TTI, right? We have a top-down trading process where we look at the broader picture first, and then we plug the stocks in that make the most sense to convey that broader thesis. And as of right now, this is risk off. It is. There's no other way to put it. Everybody wants to find the bottom, time the bottom. These risk ratios are going to give us a good understanding of when financial institutions have declared that there's a bottom in play. Until these things stop blowing out, the bottom is not in. You can look at something like an XLY against XLP as well, which you can reasonably think about as offensive versus defensive stocks, right? Consumer discretionary, Amazon, Tesla, Ford, General Motors, right? Stuff like that, Home Depot, Lowe's. Against consumer staples, which are your Coca-Colas, your Pepsis, your Procters & Gamble's, your Johnson & Johnson's. Think about it. When you have a bunch of money in your pocket, where are you going and spending it? When you don't have as much money in your pocket, what do you still need to buy? That's what we're thinking about, offense versus defense. This ratio breaking down tells us that financial institutions, once again, not retail, me and you and everybody listening to this does not influence this ratio at all, basically, unless we're holding at hundreds of billions of dollars of Tesla stock, which nobody in here is. We're not going to be influencing this ratio. And this ratio is telling us that financial institutions are preferably holding defensively positioned stocks, your J&Js, your PGs, your KOs, your PEPs, right? They don't want to own the higher beta offensively minded stocks. And whether it's tariffs or any other fucking reason, it doesn't matter to a technical trader, right? For those of you listening to this, every single one of you should be a technical trader. We don't use fundamentals whatsoever inside of TTI. You don't need to know what type of company or what their PE ratios are or their exposure to tariffs. You don't need to know any of that. What you need to know is that right now, offensively positioned stocks are underperforming defensively positioned stocks, and that tends to happen during what? Bear markets. What is this? 2022 to the end of or beginning of 2023, consumer staples outperforming consumer discretionary. What did we start to see back in, I believe it was January, the exact same type of conditions. You can go back and see all of this, right? This was the COVID breakdown. This was the 2018 bear market that lasted just a couple of weeks, but still, right? These ratios can keep you on the right side of the fence here. So when these stop going down, and by the way, there's a lot of these that we look at inside of TTI, not just these two, but when you see these ratios start to bottom out is when you can start to think to yourself, okay, there's probably a pretty good chance that the market is also bottoming out. Obviously, once you see those ratios start to flip, we go and we confirm it with TA. Is there a risk level? Is there something that we can reasonably append to trend here with these major market indexes, et cetera? As of right now, there's not. So once again, before I hop off here and get prepped over in Discord and over on our market research portal, but 478.50 is the level that I'm looking at for SPY. If we hold that, I think there's an opportunity to start digging in and buyers coming in and saying, okay, that's enough. We're probably going to see risk ratios start to even out as well, but we're not there yet, so we are not buying the dip. And the Q is 405. It doesn't have to be any more difficult than do we hold previous cycle highs. The Dow looks the exact same, by the way. I don't have it charted up effectively. I guess I do, actually. The Dow held the level, right? These are 2021 highs. And then also, your Mag 7 index held 2021 highs. There's a lot of confluence at these 2021 highs. Not all of them are going to hold. Maybe all of them hold. I have no idea. What I do know, though, is if we flip below that level, there's arguably going to be more pain. If we hold these levels, we can start to hunt for opening positions to the long side, but we're not there yet. Okay, as you can tell, I'm pretty tired. I stayed up all night. I'm not a news guy, but I'm interested in what's going on here. This is absolutely insane. China just announced more tariffs going into effect tomorrow in the United States. We'll see what happens to the market as of right now before I leave you guys. China is up 1.41% while the United States market continues to fall. Last thing I'll say before we go, get rid of this. I was comparing Bitcoin to gold. Do you guys know that over the last year, gold has outperformed Bitcoin? Imagine that. Gold up here, holding up relatively well. Do they eventually sell gold? It's been volatile over the last couple of sessions, but holding above 3,000 is a good indication. We're still long gold. We're still long gold, some gold miners. But everything else in the market right now is really getting pounded. So be very careful with where you place your money. Don't be overzealous with shorts at the hole. Remember, you can always fight to live another day. That's what we're focused on here inside of TTI. Most of our clients have decent-sized accounts, and they're not willing to give back the profits they've made over the last 2 years of an incredible bull run. So sit tight. When markets flip, we'll be on it. Watch those risk ratios and be careful about that credit event risk. HYG against IEI. Throw that on your trading view and look at it once per day. Okay, my name is Hamilton. I'm here at the Trading Initiative. If you like this type of content, please like and subscribe. Good luck today. Follow me on Twitter if you're not already, at How to Swing Trade. I give intraday updates there, things that we're looking at inside of TTI all day. Enjoy your Wednesday.